Hey there, investorholics and friends. Thanks for stopping by to check out the ETF Spotlight review. Today we'll be looking at IOO, which is the iShares Global 100 ETF. This one's domiciled in Australia. It's a bit of a change from the old setup. This one is by BlackRock, so iShares is just a BlackRock company. Hang around. This one's pretty interesting. It's a reasonably higher rated ETF, so something that could possibly form the center of a portfolio. Well, hello there, investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay guys, let's dive right in and take a look at the investment objective. So the fund seeks to track the investment results of an index composed of 100 large capitalisation global equities, so the big 100 companies. The index is the S&P Global 100, and that's designed to measure the performance of the 100 multinational companies, supposed blue chip companies, so of major importance in global equities markets. So pretty much the 100 biggest companies are going to be looking at here. So why would we do this? Gives you exposure to a broad range of large international companies in developed and emerging markets, but pretty much it's all developed markets. You look at the breakdown of where these companies are located. Access to 100 of the largest companies or stocks in one single fund. So with one trade, you get a slice of the action for 100 companies. Used to diversify international and seeking long-term growth opportunities in your portfolio. So a lot of Australian investors specifically tend to have more exposure to just Australia, I suppose, because traditionally it's been difficult to purchase investments outside the country, but that's changing. International brokerage and also with ETFs these days, you can get a bit more exposure outside the country. Okay, so we had a net asset value at the close of 76.07, trading just above that at 76.46. Market cap sitting around $1.8 billion. Management costs 0.4%. I think that could possibly be lower. They haven't adjusted that for over 2 years, I think, from memory. So distribution, when they pay a dividend, semi-annually, so January and July. Dividend yield, it's about 1.84%. That's dropped off since I had a look at this one 12 months ago or thereabouts. Was sitting around 2. It's come back a bit. So as advised on the packet, IOO tracks the largest 100 companies in the world. It focuses mainly on the United States, with 70.61% of the holdings coming out of that country. So it's increased a little bit from when I had a look at it last time. So at the top holdings haven't changed since I looked at this one last time either. So Microsoft, Apple, Amazon, Nestle, and Samsung. So including IO in your portfolio would give, it'd be a good move because it gives you all those companies, and they're all mature companies, and they're all pretty much profit generating machines. So they spit off cash. They're quite mature businesses, and there's still a bit of room to grow for a lot of those ones as well, Apple and all those ones. So these companies have earned their place at the top of the world's markets due to their long track record and high performance. Another reason, as I sort of touched on before, be a bit more specific. So if you invested or used IOO, that would allow you to be invested in assets that aren't correlated with Australian equities. That will allow you to spread your risk a bit. So if for whatever reason the economy's down in Australia, typically global economies are inverse or thereabouts. So you'll still be getting possibly still be getting good returns from your international investments, even though your Australian investments might be down for whatever reason. So global equities are affected by a much broader and different set of economic factors than Australia, such as aging demographics, and that can influence demand on healthcare, rising consumption in developing nations, and increasing role of technology and the internet having in the daily lives of households and companies. So, you want to have a bit of diversification just to protect you from whatever downsides in the market, in the broader market anyway. So I also suggest having a look at IWLD and QLT and ETH. So from memory, they've also got a bit lower fees and a little bit broader base as well. So if you invested $10,000 into the ETF on the 5th of December 2000, you're probably a bit unlucky because you just picked the tech crash and all the turmoil around the 2000s. But if you'd left your money in, you'd have $17,500 roughly today. What's that? 19, almost 20 years later. Well, you would have done much better if you'd put your money in after 2010. Your returns would be a bit better, I should say. So your top 10 are Microsoft, Apple, Amazon, Google, Johnson & Johnson, Nestle, JP Morgan, Procter & Gamble, and Intel Corporation. So only one not international, but sort of company outside the US there, which is Nestle. They're in Switzerland. I think the company is best placed to weather the COVID-19 problems that we're seeing now. Definitely the companies with size, and that's a great advantage. So, if you're looking to purchase an ETF, this one you're getting, in one trade, you're getting 100 of the world's largest companies. I think it's a pretty good way to start a portfolio. So if you had one Australian ETF and one international ETF, this one wouldn't be a bad one to start off with. You could definitely pick much worse ones than this, so definitely one to consider anyway. So this one's reasonably well rated by Morningstar as well. So that's had a bronze, and it's had a bronze rating for quite a while. So if you think about out of 5 stars, so your bronze equates to 3 out of 5 stars. So it's not too bad. So it's in the middle to the higher range of the rating. So definitely one to consider if you're looking to start a portfolio. Hi guys, yes, this is our little standard disclaimer. I do not know your personal circumstances, and this is not financial advice. I'm not trying to promote any particular thing here. It's educational and just showing you guys what's out there and what the possibilities are. So please take that into consideration. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left-hand side and caress the subscribe button on the right-hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks, guys. See you later.